Chapter 15 has a variety of topics about stockholders' equity. Many of the assignments have a video in Wiley Plus to assist you with working through those. There were just a few, though, that did not have an accompanying video, and so that's what I'm going to be lecturing over. So I don't really have a topical theme with this particular group of lectures. Rather, this recording is really just the topics that didn't get addressed in videos in Wiley Plus. The first one is brief exercise 15.6. And by the way, I recognize this may be a little bit blurry for whatever reason. So if you're unable to read this, just pull open your book and turn to brief exercise 15.6 and you'll be able to read the narrative. Brief exercise 15.6 really looks at stock issue costs. So in this particular problem, we have a corporation issuing 2,000 shares, $10 par value stock for $60,000. So it's issuing it above par value. They also incurred $1,500 of costs associated with just selling the stock. Now I want to contrast this because we just finished chapter 14 on bonds and we looked at bond issue costs with that. So when we had bond issue costs with bonds, we would have seen, in this case, cash would have come in. $60,000 was the issue price, but they also paid out $1,500 for those issue costs. So the net cash coming in is $58,500. And so that's what we're going to see coming into our cash account, and that will be our debit, $58,500. Now, if this had been bonds, we would have credited bonds payable for the face amount. So we'll say this $10 is the individual face amount of the bond, 2,000 shares, that's $20,000 face amount going into bonds payable. These bonds then would have been sold at a premium, so we would credit premium on bonds payable. Now also keep in mind the bonds were issued for $60,000, so that would have been a premium of $40,000, and that's how we would have looked at it with the bond. Then we would have accounted for the $1,500 bond issue cost. We would have put that in a deferred charge account. So we would debit bond issue costs. Again, it's a deferred charge. And that $1,500, we would amortize that, right, expense it through amortization over the life of the bond. And that's how we handled it with bonds. But let's contrast that with stock, because the method's going to be different. Whether it's right or not, we've got different ways of thinking whether it's bonds or stocks. So if it's stock, we've got our $58,500 cash coming in. And then we're going to put in the common stock account the par value, which is $20,000. And then we're just going to put the excess paid in capital in excess of par value. We'll put that $38,500 in it. And we do not separately account for the bond issue costs. The next item I want to look at is exercise 3. Exercise 3 reads this way. There are 25,000 shares acquired by a corporation for $53 per share were exchanged for undeveloped land. And the land has an appraisal value of $1,700,000. At the time of the exchange, the common stock was trading at $62 per share. So we've got shares reacquired. So really that's treasury stock, isn't it? So we've got some treasury stock that this corporation is going to exchange for land. So it's a non-cash transaction. So it's a non-cash transaction. We're giving up treasury stock in exchange for land. So let's go back. We have seen, these non-cash transactions several times. So here's our rule. When cash is not part of the exchange, we use the fair value of either what is given up or received, whichever is more reliable. Well, we have two fair values here. We have a fair value of the land, which is an appraised value, and we also have a fair value of the stock, which is on an organized stock exchange. So which one's more reliable? Well, the appraised value is we could have different appraisers and hire different appraisers and get different values. They might all be close to $1.7 million, but they probably wouldn't all be exactly $1.7 million. However, on the stock exchange, that's fact. I mean, that there would have been, like stock, our stock, not our particular shares, but the company's other stock, shares of stock, were sold and purchased at $62 per share. So this is by far the more reliable fair value, what it's really worth. So it certainly is. This is a ready market. There is a ready market here for the stock. The appraised value is what somebody thinks it would sell for, but there hasn't actually been a transaction. Over here, we have an actual transaction with other shares of stock. So we're going to record this then at the $62 per share. So let's see, if we take $25,000 shares, not dollars, at $62 each, we should get $1,550,000. And so that $1,550,000 goes into the land account. So there's a debit to land, $1,550,000. So that's the land. And then we will credit the Treasury stock account. If you can't read it, I'm just going to abbreviate there. We take out of Treasury stock the cost. So that's going to be 25,000 shares. And those had a cost of $53 each. So that's $1,325,000. $1,325,000 we credit Treasury stock. And then the difference is, seems like a gain, $225,000, and I'll put it in quotes, gain, but we can't actually have gains on Treasury stock because it's not an asset. It's a contra stockholders' equity account. So this gain goes into the paid-in capital for Treasury stock account. Problem 6 focuses on transactions with Treasury stock. So getting started, we have Washington Company has the following stockholders' equity accounts at the end of 2014. So there's common stock. It has a par value of $100. There's 8,000 shares authorized, and the account has a balance of $480,000. So we could figure out, let's kind of schedule out how many shares are issued then at that point in time. So number of shares issued, so $480,000, and we have a par value of 100. Keep in mind the common stock account, right? It tracks par value. So that's going to be 4,800 shares. So there are 4,800 shares that are issued because the common stock account represents issued shares. So at 12/31/2014, there are 4,800 shares issued. Okay, so let's go to the transactions. So the first one, these are all for 2015. They bought 280 shares of outstanding stock at $97 per share. So again, on our first transaction in 2015, let's schedule out Treasury shares. So shares in the Treasury, they are buying 280. So there are still 4,800 shares issued. Of those issued, 280 now are coming back in the Treasury. So now let's look out outstanding shares then. If I can squeeze that in. The outstanding shares, 4,800 minus 280 would be 4,520 are outstanding. And we're going to schedule these out because only outstanding shares receive dividends. So we have, at one time or another, the company has sold or issued 4,800 shares. 280 of those we bought back. They're in the Treasury. So now there are only 4,520 that are outside the company outstanding. Okay, and so when we do this, I hope you can see there's a debit to Treasury stock and a credit to cash for the cost. So $97 for 280 shares is a total cost of $27,160. So that's the dollar amount of the debit and credit. Okay, then on the second transaction, they declare a cash dividend. So of $20 a share. So only the 4,520 shares will receive the dividend, and that dividend is $20 each for each share. So that's going to be a cost of the dividend, $90,400. So we can see, here's our debit to retained earnings, here's the credit to dividends payable, because that's the date of declaration. On the date of declaration, here's the date that it's declared. So on the date of declaration, we debit retained earnings, $90,400, and credit the dividends payable. Transaction 3 is a date of payment. So here's the date that they actually paid the dividend, the payment date. So dividends payable goes down, and cash is credited. Okay, now let's go on to number 4. The Treasury shares purchased in one above were resold at $102 per share. Okay, well let's go. I'm going to go to the next page. I set up some T accounts. I'm going to go post this debit, $27,160 to it. And then we're also going to go ahead and post the retained earnings. So I'm going to go do that. Okay, so transaction 1, we had a debit to Treasury stock, $27,160. And recall, that is a contra stockholders equity account. It's a negative stockholders equity. It is not an asset. Even though it's got a debit balance, it is not an asset. It's a contra stockholders equity account. Over here on retained earnings, let's enter in its beginning balance. $294,000 was the beginning balance. And in transaction 2, we had a dividend of $90,400. So there's our dividend, $90,400, transaction 1 and 2. And just a note, Treasury stock is going to track the cost of the Treasury stock. So it does not track par value. We're going to track cost of the Treasury stock. So it's not tracking par value like common stock does. It's going to just keep track of or count of the cost. Okay, so keep in mind we originally paid $97 for this, and now we're going back out and selling it for $102. So it looks like we have somewhat of a gain on this, doesn't it? So let's look at that. So our total issue price of the Treasury stock would be 280 shares. Selling all of those for $102. $102 would be $28,500. $28,500. Okay, so let's look at the transaction. So that's a debit to cash. For the $28,000, I said $500, it's $560. So $28,560. I'll write that out just so you can see that. $28,560. We take cost out of the Treasury stock, right? And let's go take a peek. If we're selling everything, that's that $27,160. And we can see there's some sort of gain here. But we don't record it as a gain because we're not selling an asset. So it's going to go into paid in capital from Treasury stock. So again, paid in capital for the Treasury stock, which is a contributed capital account. Okay, and let's go post that $27,160 and then also this $1,400 gain into the contributed capital, paid in capital account. Okay, so we have $27,160 coming out of Treasury stock, transaction 4. And after we do that, now we have a zero balance in Treasury stock. And we also had a $1,400 credit, that was that quote gain, from selling the Treasury stock. of $1,400. And again, I want to emphasize, I'll say quote gain, but it's not, doesn't get reported as a gain because we're not selling an asset. Okay, so on transaction 4 then, those 280 shares were reissued or resold. So we still have 4,800 shares have been sold or issued at one time. The 280 now that were back out here outside the company, they're outstanding. So we still have 4,800 shares have been issued. Before transaction 4, 280 were held in our treasury, were held by the company, but now those came back in and they are outstanding. Okay, then transaction 5, 500 shares of stock were purchased at $105 per share. So let's just put this up here. 500 shares are going to be repurchased at $105 per share. So that's going to be a total cost of $52,500. Okay, so we're going to debit treasury stock for the $52,500. Cash gets credited for the $52,500. So let's put that in a couple of places. So now we have the 4,800 shares that have been issued at one time or another. 500 of those are back in the treasury, which means only 4,300 are outstanding and available for dividends. I also want to post this $52,500 in my treasury stock account. Okay. All right. Last transaction. Of the 500 shares, they were resold at $96 per share. We issued them at $105. Now we're going to, so we paid $105 and we're going to resell those for $96. So we have a loss on this transaction, don't we? So let's see. We're not selling all of the shares, only 350. So 350 shares at $96 each is going to be proceeds of $33,600. $33,600. So cash is going to come in $33,600. Okay. So again, we're going to record cash coming in of $33,600. So cash, $33,600. We also want to take out cost from the treasury stock account. So 350 shares, and we purchased those at $105 each. So if, I want to make a point here. If cost goes into treasury stock, then cost has to come out of treasury stock. So if we put it in at $105, then we've got to take it out at $105. So we want to take it out of the treasury stock at its original cost, which is $36,750. Okay, so we are going to credit treasury stock $36,750. So we have a debit to cash, $33,600. Here, I'll just put it here in case you can't see that, $33,600, and we have a credit to treasury stock, $36,750. So we actually have a loss on the transaction. So what do we do with the loss? Well, let's figure out how much of a loss do we have. So 33,600. So 501. So we have a quote loss. We're not going to report it as a loss, but kind of, I guess, in economic substance, it sort of feels like a loss. We bought something for 105 and turned around and sold it for 96. We seem to have a loss, but we're not going to record it as a loss. So 3,150. Well, now we have to think, where are we going to put that? Well, the first thing is, if we had paid-in capital that's associated with treasury stock. So if we have paid-in capital associated with treasury stock, we're going to take it out of there first. So we're going to, but we don't want to have a negative balance in the treasury stock account. So we're going to debit the paid-in capital associated with treasury stock for its balance, because the loss exceeds the $1,400. Okay, so over here we're going to debit the paid-in capital treasury stock for the $1,400. Now, if it had been less than $1,400, we would just take all the loss to the paid-in capital treasury stock. But we can't take all of it to the paid-in capital treasury stock because there's only $1,400 in there, and it would not make sense to have a negative balance in a paid-in capital account. How can you have negative paid-in capital? You can't. So we just take the portion of the loss to the paid-in capital treasury stock to the extent there is a balance. Oh, wrong way, sorry. So we have, here in number 6, transaction 6, we've taken as much of the loss as we can to the paid-in capital. And then the difference is just going to go to retained earnings. So the remaining loss, we're just going to take to retained earnings, and that's the $1,750. So the $3,150, part of it goes to paid-in capital treasury stock to the extent there is a balance. And then if there's still more loss, we take that excess to retained earnings. So let's go post that $1,750 to our retained earnings account. And that gives us a balance now of $201,850 in our retained earnings. Okay, so that is part A of that assignment. So we finished all of that out. And by the way, they didn't ask for it, but let's go ahead. Part B is going to ask us to prepare the stockholders' equity section of the balance sheet. So I'm going to set up the common stock account. Let's go back to the very beginning. Remember, there was $480,000 in that account. So that was the beginning balance in 2015. That was our beginning balance. Now, I also want us to go take a peek at all of these transactions. We did not make a journal entry to common stock account. So that balance has just stayed there the whole time. Okay, so now they want at the end of 2015 to schedule out the stockholders' equity section of the balance sheet. And they tell us there was net income of $94,000. Well, if there had been net income of $94,000, right, the revenues and expenses would have been closed to retained earnings, which means net income would have been closed to retained earnings. So then our ending balance would be $295,850 to retained earnings. Okay? So now we're just going to take these accounts and put them on the balance sheet. So we have, there's no, the $480,000 goes in the common stock account. So we have common stock, $480,000. So there's that balance. We have the $295,850. It's reported as retained earnings. And then they're just doing a total paid-in capital and retained earnings. So they're adding those together. And then we want to subtract out this $52,000, so less. So subtract out treasury stock, the 15. I messed up. I didn't post our last transaction to treasury stock, did I? I did not get that $36,750 posted there. So let's do that. $36,750. So that will give us an ending balance of $15,750. So transaction 6, we had the debit to these two accounts and then the credit to treasury stock. Okay, so now treasury stock has a balance $15,750. And then just add up all three and you will get a total stockholders' equity of $760,100.